What if you could control 100 shares of a company like Apple or Tesla for just a fraction of the cost of buying a single share? That is the power of options. Most people think they're complicated or just for pros, but today I'm breaking them down into plain English so you can use them to protect your portfolio and amplify your gains. Let's dive in. What is options trading? Okay, simple English. Options trading. Options trading is where you can bet either that the stock will go down or up, and you can make much more money than actually purchasing the actual stock. Okay, this is where most people in the stock, literally 98% of the people that are millionaires through the stock market make money through options trading, or people make millions through penny stocks, which are way riskier. But today I'm giving you a lesson on options. Another day I'll give you a lesson on penny stocks. Okay. Now, how do options work? There's something called calls and there's something called puts. Calls means you're betting that the stock will go up. Puts means the stock will go down. Just think about it like, let's say you owe some Tesla shares and you want to have some insurance on your stock. You believe that Tesla's trading now. Tesla's trading at about $408, and you believe that Tesla's going to go down to, let's say, $400. You're buying insurance on your stock and you're protecting yourself. For example, if you have, let's say, $100,000 purchased into Tesla stock, worth of Tesla stock of 100K, and you purchase like 2, 3 options, yeah, you're protecting your 100K because you're making your money through your options. Now, how do people really make money through options? It works with, once you reach your strike price and your break even, then each dollar that it goes up or down, depends if you purchase puts or calls, you make $100 per share. With that, let's break it down. Let's go to options. Let's go to calls. Let's say Tesla's trading at $408 right now. You believe Tesla's going to go trading, let's say, to reach $410. So you're going to purchase this contract with a strike price of $410. This is where your strike prices are. Okay, you believe, let's say, 410, 412.50, 450, 417.50, etc. You believe Tesla's going to go up to $410. You're going to purchase this for just $290. Okay, it says 2 and then dot, which means it's 200, and then it's going to be 91. Okay, for example, this one, it's just $38 because it's zero in the beginning. That's how it works. Okay, so you're going to be purchasing it just for $291. I mean, I'm recording this while the market is moving, so just ignore the movements. It's just an examples, how to get the theory out and how to learn how to trade options trading like a pro, okay? So you're going to be going to call. You're going to go to 410 track price, 293 now, whatever. Tesla's trading at 408, right? So when you break even at 412.91, you double your money. Why you double your money? That's because of your delta, theta, gamma, vega, RHO. I mean, let's skip the theta. Let's skip the theta because theta will kill your option as the time moves on. I will be giving you another lesson, a separate lesson on especially the delta, theta, gamma, vega, RHO, and the IV, intrinsic volatility. That's like one of the most important ways how to use and how to know which contracts to purchase. But it just, through options trading, can take days until you finally explain it the right way, and it can take multiple hours of creating videos as well. So the simple strategy how to use options trading is going to be in this video right now, okay? So again, calls is you're betting that the market's going to go up. Puts means you're betting the market's going to go down. If I purchase the 410 strike price for just, let's say now it's $295, right? Once it reaches my break even of $412.91, after it reaches, let's say 430, so then I double my money, I get 100% profits, which means 290 is times 2, right? And then once it reaches $413.91, I get $100, and so forth. Each dollar that it goes up, I make $100. From 413, you make 100. 414, I make 100. 415, I make 100. 416, 417, 418. So technically, I can purchase this for $288 now, right? The market is moving, and my max profit is unlimited. Max loss will only be, let's say, $285 because I'm only risking $285 because I'm purchasing the option for $285. Okay. Now, I hope you understand the basic concept. Same thing works with puts, right? Puts means you're betting against the market, where, let's say, Tesla's trading now, let's say, at $408, right? Now, you believe Tesla's going to go down to, let's say, $400. So you're going to be purchasing this contract right over here for $400, strike price 400. Once you break even with 399.02, and I'll explain why it's different over there. It's called premium. I'll explain that in a second, but first let's finish this lesson, right? Once I reach break even 399.02, 05 now, whatever, I will be doubling my money, 100% gain on, let's say, $96 right now, right? And then when Tesla goes down, let's say to 398.06, then I make $100. And then if it goes down to 397, then I come out in a total profit of $200 plus my double, the double from the 0.96, right? So now what is all these numbers? Now, how do they calculate how much options should be costing? So everything is times 100 shares, okay? So let's say 280 now, right? it's going to be times 200 shares. This is a call, right? The strike price 410. But this is called, there's another name, another name to it. It's called premium, okay? How it works is, yes, I bet that Tesla is going to go up to $410, but not necessarily you're going to be making money until it reaches $410. You can be making, it's impossible to know because each time it depends on the market trend and everything. It depends on the volatility, which I said I'll be saying in the next video. Same thing goes with delta, theta, gamma, vega, and RHO. This all works, all five things together works the same way on how to know when your contract is going to be either expiring worthless or not. Now, there's different days to expiration, but I'll get to that in a second. But first, let's break down what the premium is, okay? Let's say it costs $284 right now to purchase the 410 stock. The premium is after 410, right, your strike price, then it's plus 280. And there you go, $12.79. I mean, the market is moving right now, so it's a bit wrong, like from my calculations I said before, right? I'm recording this while the market is moving, but get the concept, okay? So now once you reach your break even, you'll be doubling the $283, right? And after that, you'll be making $100 per each time Tesla goes up to, let's say, 413, 415, 416, 417, 418, 419, 420, etc. That's how it works, okay? Simple. I just taught you basic options in literally 6 minutes and 18 seconds, okay? Now, we're not done yet. Now, there's different days to expiration, okay? There's 1 day to expiration, 4 days to expiration, 6 days to expiration, 8 days. It's literally every 2-3 days to expiration, especially in the Mega 7, but not in every single stock it is. In SPY, the S&P 500 ETF, there's expirations every single day. This is meant for more professional traders, the pro traders, especially to do 0 days to expiration, because I'm telling you now, you can be losing every single penny of your investments if you're not professional in this. You have to know what you're doing. You just have to know how to trade and how to play the market properly, okay? I'm telling you, first do longer term swing trade options. That's how I'm breaking it down in Tesla, okay? You don't have to do 1 day to expiration. You can do 4 days to expiration. You don't have to do either 4. You can do 10 days to expiration. Be safer. Why am I saying this? Because the longer their expiration is, the longer, until your contract expires, then your contract won't be going worthless so quick. But why? Because there's something called theta. Theta kills the timing, right? You have until 4 o'clock close, let's say till tomorrow. I'm recording this on February 26th, right? So you have until February 27th is the expiration at 4 o'clock close. If it does not break even, let's say we have a call, right? And it does not break even, Tesla doesn't go to 410 plus, then your contract will be expiring $0.00, and you'll be losing your max loss, right? But your max profit, you won't get anything, right? Because it went the opposite direction. Therefore, options is very risky, and you have to really know the market. So play with smaller funds, learn the algorithm. Once you know the algorithm, then you're going to understand how it works, okay? Rather do longer to expiration than doing shorter to expiration. Like that, you won't kill your options through theta, right? Delta is actually the one that juices up your premium, which we'll be explaining because it's a huge explanation. Same thing goes with theta, gamma, and vega. We just cannot do it right now. You have to first process how options work. Then there's something called also, before we go further, let's just explain, right? So you buy, let's say, a contract today. So let's say I purchase a 1 day to expiration. I buy this for $290. I press submit, right? So that means I'm betting that the market's going to go up. I bought a call for the 410 strike price. If by tomorrow this is up, let's say, with $415, then I make what? In my break even, let's go to my break even. It's time. My break even is $412, right? Right over here. So 412 is going to turn into a double. So my 285 is going to be coming times 2. And then if it reaches 415, as I said, right, it's going to be going 13, 14, 15. I'm going to be making additional $300. So I can potentially come out with not only 280 times 2, right? The market is moving now as I speak, just like I said before, right? I can also be coming out with an additional $300. So that's the difference between OTM and ITM. OTM means out of the money. ITM means in the money. And then there's something called at the money, ATM, which Tesla's sitting at 408, so that would be like the best contract would be 407 right over here. This would be considered at the money right now. At the money means you're purchasing a contract the same price, how much it actually cost. Right now, Tesla costs $408. I'll be purchasing a contract that costs $408. And right now, there's no, okay, Tesla goes with every $2-3, but like let's say if we go to SPY, S&P 500, right, ETF, let's say it's sitting at 689, right? So I can be going to strike price 689, right? This is 0 days expiration, right? That's why it's dirty cheap. Another thing, the further to expiration, right? The cheaper it's going, the more expensive it's going to be. Why? Because you have your premium. There's a bigger chance that you can actually hit your strike price. But the closer to expiration is going to be even cheaper. Like we're in ITM, that's why things are expensive. But if we go to OTM over here, which I'm going to be explaining in a second, let's go puts. Like all these puts, they're going to be expiring worthless one by one. Because why? Because the market had a pretty good shift today. It went all the way down. So if you did zero to expiration and you sold at the lowest point, it opened at 693, right? And it went down to 684. You could have been making a nice 400% profit just from buying a single option over here. So if it would, it's beginning of the day, and I'm sure the volatility was also pretty high, right? The volatility right now is actually also high right now. I'll explain in the next video as well, but it's 26%, which means in the morning this probably costed you, let's say the 693 probably costed you about 250 bucks to 300 bucks to purchase. But when it went down to 684, you would have sold it for a nice 7, 8, 900%. You would have seen between 200 and 300% gain, if not more, right? It's impossible to tell you exactly how much it is because, again, it all depends in the gamma, theta, vega, RHO, delta, whatever, which I'll be breaking down because it's a huge, huge, huge thing to break down. Now, back to what we were saying, OTM, ITM. OTM means out of the money. ITM means in the money, okay? OTM means you're purchasing it out of your strike price. ITM means you're already in your strike price and you believe it's going to continue on, which you're going to be easier to break even. So now what did I say? Okay, let's not gibberish talk. Let's break it down. When I do OTM, it's extremely risky because it's going to be dirt cheap. You're still out of the money. You didn't hit your strike price, right? For example, let's explain in ITM. You'll understand it better. Let's go back to Tesla actually because we're breaking it down in Tesla. It's going to be way easier. Let's go to options. We're going to go to let's say puts ITM, okay? For example, you see they're making a 62%, 77% profits and everything. It's not only that, because if you're purchasing it with a cheaper premium, your premium also gets juiced up through delta, which we'll be explaining later. For example, if I, let's say, purchase a put and I want to do ITM, right? So I'm going to be purchasing for $410. It's going to cost me $395 versus doing OTM, a put. There's no put for $410. Why? Because the put is already in the money. For example, the $410 is already gone. Meaning to say, Tesla's trading at $408 right now, right? $408. So the $410 would have been OTM if Tesla would have been trading now at, let's say, $411. Since it's trading at 408, the 410 strike price is already in the money. For example, that's why you see it's worth $395. But versus going to OTM, the latest contract, it's $277. You see, it's $100 more. Why is it $100 more? Because it's ITM. You already made $100 per contract because you already moved down with $1 already after breaking even. So you just can continue purchasing the contract and you can continue making money. Continue. See all these contracts. This contract, let's say, is worth 445. Strike price is worth $3,634. Why is it worth so much? Because from 445 all the way down to 408, right? Each dollar that went down, you made $100, right? So from 444, $100, 443, $100, another $100, another $100, right? So that's how much your contract is going to be worth when it expires. I mean, it's expiring tomorrow. I don't know exactly how much it's going to be worth, right? Again, this is not financial advice. It's just teaching you the basic lessons in the market, okay? The simple, basic strategy on how we do it and how we work, okay? That's the difference between OTM and ITM. OTM means out of the money, where you're purchasing something. Hopefully, let's say Tesla's going to reach $397. You're purchasing it for dirt cheap, but you can double, triple, triple your money if it goes down to $397 because the premium is also going to shoot up, right? Versus ITM, where you're already having intrinsic volatility, intrinsic volatility means you already have the $100 per share already because you're already in the money. So over here, let's say 410 to 409 now currently, right? You have that $100 already in the thing, right? It's moving now, right, as we speak. So I hope you guys understood the basic concept between OTM, ITM, puts, calls, strike prices, days to expiration, etc. In my next video, I will be giving you strategies, like over here, what is a covered stack, what is a vertical spread, straddle, strangle, calendar spread, diagonal spread, collar, butterfly, condor, iron butterfly, iron condor, and then the custom, which was where I was explaining over here. Exactly, you can pick your own and choose your own. So for now, if you want to learn your basic options trading, and if you're already a technical trader where you can assume you're like 80 to 90% chance that you're going to be right, you know when it's like if you know to read charts or indicators, and you believe, let's say Tesla's going to reach 400 or Tesla's going to reach, let's say 420, you want to buy a call or a put, try it out. I'm telling you, you can make a killing, but you can also lose a lot of money. If you don't know what you're doing the opposite thing, you can lose every single penny. Trust me, do not go wild. Start off with the cheapest as possible, okay? Just trust me. If you want, learn it in SPY and S&P 500. You can do zero days expression just to learn if you want, right? Because it's dirt cheap, but you have to be ready to lose this money. You can just purchase it for $87, but you have to be ready to lose the $87 because what happens if you're not professional enough? You don't know what's going to happen, right? So you have to actually know when to buy and when to sell, right? So that's where it all comes down to my first video where I explained what the VIX is, right? The VIX explains if it's above 16 when the market's in fear mode, above 20, above 25, when we know when the market's gonna have a pullback and a correction, a market crash, and how big, etc. All these things, right? So that's what we have to know, the basic concepts and the basic things. I hope you all understood the basics of options trading. Please share, like, and subscribe. Like that, I know that I'm not wasting my time and people are actually listening to my videos because I'm here to teach people for free. I don't have a Discord. I do not have a Discord. This is 100% for free. So please share, like, and subscribe. And you can write in the comments if you want to learn anything and everything. I'm ready to teach you guys. Have a good one.